business will continue forever for an indefinite period. So here we are saying our business is continuous in existence. Whatever you purchase, we value only at the cost price, not at the market price. There are two types of transaction. One is called the cash transaction, and it's called the credit transaction. We prepare the profit and loss account, which gives the result of net profit or net loss. We prepare the income and expenditure account. The difference may be surplus or deficit. Hello, my dear student. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Grade College, a Temple of Excellence, MYSURU. Today, in this session, I am going to hand Fundamentals of Financial Accounting, First Semester, Unit 1, Session 2 of BCom, in favor of Accounting Concept. Here, we are going to deal already I told you what is an account, what is accountancy, what is personal account, what is real account, what is nominal account, what are the rules of this. A personal account is one which deals the accounts of person. Example, X account, Y account, bank account. Again, bank followed with some name. Then real account. Real account means the property which you are having. That just like land, building, machinery, furniture, cash. Then nominal account, all expenses and losses will show in the nominal account. That is rent paid, rent received, commission paid, commission received, discount allowed, discount received, general expense. And there are some principle already you have followed. There are some principle for personal account, we call as a golden rule, some principle for real account, some principle for nominal account. What the rule of this personal account? Debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, all gains and incomes on the credit side. Now, I'm going to explain what are the accounting concepts are. Which are the concepts you have to follow regarding the accountancy. So, we'll go with the accounting concept one by one. First one, what do you mean by accounting concept? First, an accounting concepts are the fundamental ideas or basic assumption underlining the theory and practice of accounting. This is part. This concept shows not only theory and practice of accounting and are broad working rules for all accounting activity. Whatever the accounting activity is there, that based on some principle, that principle we are going to explain. So, what is accounting concept? They are the fundamental ideas of basic assumption. Whatever the basic assumption is there, the idea will give under this concept, underlining the theory and practice. Here the important is this word, theory and practice. It not only explains the theory, how to adopt that theory also, this concept is going to be explained. So theory and practice is like the theory they will explain, practice they are going to adopt. Accounting and our broad working rules for all accounting activities. Then move on. The following are the general concepts. We'll follow one by one. Business entity concept. First concept, business entity concept. This concept recognizes business unit as a separate and distinct entity from the owner. So here they say that business is separate, owner is separate, but that belongs to owner only. But we think here one side as a owner, one side as a business. This is the unity. Separate, distinct entity, business separate and distinct entity from the owner. So we talk business as a separate and owner as a separate. Both the parties are there. One side as a business, another side as a owner. But that belongs to owner only. But we separate. From the point of the owner, we look after. From the point of the business also, we look after. There are 2 points. From the point of business, from the point of owner. Owner is contribute the money. Who is the receiver? Business is the receiver. Who is the contributor? Owner. From the point of the owner, he is a contributor. From the point of the business, he is the receiver of the money. Business is the receiver of the money. The personal transaction of the owner is separated from the business transaction. Here, the personal transaction of the owner is quite different from business transaction. We are talking about the business. Who is the contributor? Owner. Who is the receiver? Business. One side as a owner, one side as a business. So though he is a owner, we talk in a separate entity. One side as a owner, one side as a business. Owner gives the amount, money is going out. Who is the receiver? Business. So business receives the money, owner gives the money. This is a separate entity. Going concern concept. This is also known as concept of continuity. Under this concept, it is assumed that business will continue forever. This is important. Business will continue forever for an indefinite period. So here we are saying our business is continuous in existence. It is continuously flows. It won't close down. It's a continuity in exist. On this concept, only financial statements are prepared. Here, only the financial statement will be prepared. It is a continuous constant and continuous existence here. We have said that this is assumed that the business continue forever, indefinite period. There is no chance of closing the period. It will continue forever for indefinite period. On this, only financial statement in terms of money will be taken into consideration. We move on to third one, money measurement concept. According to this concept, the accounting records should reflect only those events or facts which are capable of being measured in terms of money. According to this concept, all asset, all liability, all incomes, all expenditure are regarded in terms of money, value at the time of spending it. Here the concept is everything will be expressed in terms of money only. We value the asset. Which are the assets are? Land, building, machinery. We say the cost of the building is 2 lakh, the cost of furniture is 10,000, the cost of what's called motor car is 20,000. All have been valued in terms of money. Then value of the liability. I have to pay him 20,000. I have to pay him 30,000 in terms of money only. All income will be expressed in terms of money. This time I got 25 lakhs as an income in terms of money only. Then expenditure, even expenditure will be expressed in terms of money. All have been expressed in terms of money. It may be asset, it may be liability, it may be income, it may be expenditure. All have been expressed in terms of money only. Then, cost concept. As per this concept, all assets acquired by the concern are shown in the accounting record at cost only. Here, whatever you purchase, we valued only at the cost price, not at the market price. We value all the things at only cost price. These assets may not reflect their market value. The question of market value does not arise at only we taken into consideration the cost of the asset, not the market value. Here in the main, all things have been measured in terms of money only. It may be asset, it may be liability, it may be income, it may be expenditure. Here, all assets are recorded at cost price only. There is no question of market price. Dual concept. This is the extension of double entry principle accounting. This is the dual concept according to which asset acquired by the business out of capital invested by the owner are shown as the asset side of the balance sheet and their equivalent value in terms of issue on the liability side of the as capital. Liability as capital. So what is double entry system? For every corresponding debit, there is a corresponding credit. If one is debited, another is credited. I'll give an example. Building purchased. What is coming in? Building. What is going out? Cash. So the entity is building is coming in, cash is going out. Furniture sold. What happened when the furniture sold? Cash is coming in, furniture is going out. So cash should be debited and furniture should be credited. Double entry. For every corresponding debit, there is a corresponding credit. One debited, one credited. That is the double entry principle of accounting. This is called dual concept, according which asset acquired by the business out of capital. Whatever the asset acquired by the what's called business out of the capital invested by the owner are shown as the assets of the balance sheet. And we purchase the building. By chance, we prepare the balance sheet here. Right hand side is assets. Left hand side is liabilities. This is your balance sheet. Right hand side is called asset side, left hand side is liability. You purchase the building. Building is purchased. Worth of rupees 1 lakh. What's the value of the asset you purchase? Building. So building is value rupees 1 lakh. That itself is your capital. Acquire owner shown as the asset side of the balance sheet and their equivalent value. Here we write capital is equal to 1 lakh. So here the meaning is assets minus liabilities is equal to capital. What's your asset value? 1 lakh. What's your liability? 0. So capital is also 1 lakh. That means our asset is our capital, say, or their equivalent value in terms of money shown on the liability side of the side as capital. So building is 1 lakh, your capital also 1 lakh. This is what this concept says. Accounting period concept. According to the going concern concept, a business firm operates from an indefinite period. However, as per this concept, the result of the business operation are evaluated in a fixed period, normally once a year. So, accounting period start from, there are 2 ways. One is called the financial year, one is called the calendar year. So, calendar year start from January, end with December, this is called calendar year. Start with April, end with March, is called financial year. I will repeat once again. So, there is a period for, so duration is 1 year. It may be calendar year, start with January, end with December, is a calendar year. Start with April, end with March, is called financial year. It is continuous duration of 12 months. This is normally once in a year. Realization concept. According to realization concept, which is also known as the revenue recognition concept, revenue is considered as being earned on date on which it is realized. This is important. On which it is realized. On the date on which goods and services are transferred to customer, and for a cash or a credit, the goods may be transferred from seller to customer in the form of cash, in the form of credit. That is, when a person promised to purchase some goods, it cannot be recorded. Promise cannot be recorded. Goods should be passed from seller to buyer, either in the form of cash or in the form of credit. Promise, the word, is not a transaction. So there must be a deal, we say. So the goods should be passed either in the form of cash or in the form of credit. Credit means the amount will be paid in the future day. Cash means same. So what is actually transaction? Transfer of property from one person to another person is a transaction. There are 2 types of transaction. One is called the cash transaction and it's called the credit transaction. Transfer of goods from one person to another person for a cash, it is called the cash transaction. Goods transferred, the amount will be paid. He promised to pay, it is called credit transaction. But promise will not be deal. The goods should be passed from seller to the buyer. Then only transaction will be made. Matching concept. The object of financial accounting is to find out trading result by preparing trading account, profit and loss account, revenue, expenditure and income is known as matching concept. Here we are going to prepare, one is called trading account, which gives the result of gross profit. Then we prepare the profit and loss account, which gives the result of net profit or net loss, we prepare the income and expenditure account. The difference may be surplus or deficit. So this goes in favor of non-trading concern. This goes in favor of trading concern. Trading concern says trading account we have to prepare to find out the gross profit or gross loss. Profit and loss account is prepared to find out the net profit or net loss. It goes in favor of trading account. In favor of non-trading concern, non-profit organization, we prepare income and expenditure account. It may be income is more, expenditure is less, then it's called surplus. If the expenditure are more and income is less, it's called deficit. A crucial concept. This concept distinguishes between right to receive cash and actually cash received. We have to receive the cash, how much actually cash received. Similarly, obligation to pay the cash and actually paid. How much money to be paid, how much money actually paid. Here, how much money to be received, how much actually received. In other words, under this concept, outstanding prepaid items are accounted. Even outstanding means yet to be paid. Then prepaid means paid more. Somebody you have to pay 10,000. If you pay 12,000, how much paid more? 2,000, which is called prepaid. If you want to pay 10,000, if you pay only 7,000, how much money to be paid? 3,000. It's called outstanding. So I have explained every concept. The most important concept here. This is important. This is the extension of double entry principle. What I told the double entry, for every corresponding debit, there is a corresponding credit. One should be debited, another should be credited. If you purchase any building, is your asset. Your asset is your capital. In accounting equation, we say A minus L is equal to C. A is asset, L is liability, C is equal to capital. What's the formula? A minus L is equal to C, or A is equal to C plus L. Here there is no liability. Our asset is our capital. That's why I mentioned here. We purchase 1 lakh building, that itself is the capital. Hope you understand this concept. This is very, very important from the examination point of view. They will ask the concepts of accounting. You have to go through this detail, and we have to mention what is account matching concepts are, what are the dual concepts are, what are continuous accounting concepts are. Accounting concepts are the principle which you are adopted in accounting. The 3 principles are personal, real, and nominal. All these activities taken into consideration. Hope you understand. We'll meet in the next session with journal entry and tribal. Till then, goodbye. Meet in the next session.